Is gold now becoming a mainstream investment? We're joined now by Simon Popple from the Brookville Capital Intelligence Report. Simon, good to talk to you again. Just answer this straight question. What do you feel has changed about the gold market? You've been commenting on this recently, and you say you've seen evidence to suggest that gold is becoming part of what many investors perceive as normal investment activity.
Yes, no, I mean, there's been a couple of events very recently that have caught the public's imagination in terms of the gold market. First of all, we've got Warren Buffett and Berkshire Hathaway. In their last report, they showed that they'd made a significant investment in Barrick. And Warren Buffett's always been sort of very anti-gold, so this was quite a sort of eyebrow raiser for the investment community. And then in addition to that, we've also had the Ohio Pension Fund, which is about a 16 billion fund allocating up to 5% of its fund in gold, according to Bloomberg, to try and protect itself from some of the ravages of inflation. So it could only be the thin end of the wedge. I mean, if we get more institutions looking at gold, it could have a profound impact on the market.
Why is this happening, and to what degree is this move to mainstream for gold likely to continue?
Well, I think there's really sort of three drivers behind it. The first is, if you look at global debt, it's just going up and up and up. And I think the only way that this debt can be serviced is for the interest rates to be going down, down, down. And so, I think it's really a case of, if you've got debt going up, interest rates going down, then the yield on sort of fixed income products is also going down. So, people are having to look, in different areas for income. I think initially a lot of people were looking at dividends, but with, the pandemic in particular, that's forced. I think there's a recent article saying that 49 out of 100 of the FTSE 100 companies had either stopped paying dividends or slashed their dividends. So, the main argument for not holding gold, i.e. it doesn't yield anything, is really going out the window.
What about the situation about inflation, though? Because I want to drill down further into this. So you talk there about the enormous amount of public debt. So holding gold is only really of any use, I think, is it not, just when you've got an inflationary background? It doesn't appear to be any inflation in the markets at the moment. So why, for that particular argument, wouldn't seem to hold water?
Well, gold has got a good track record in both inflation and also deflation. And whilst I don't think it's the magic wand answer to any particular circumstance, given all the money printing going on, I think that people are scratching their heads wondering why there isn't more inflation. So I think quite a lot of the behaviour moving towards this market is preparing oneself in case there is inflation. It's a bit like buying insurance. You buy insurance before an event, not after an event. And I think that's what's happening at the moment in the market. I think people are probably moving in and viewing it perhaps as an insurance in case there is inflation, because if there is inflation, the price could move up dramatically. And, I think they'd rather buy it now than then.
So you see this move as an insurance rather than an investment. You talk about Warren Buffett. I mean, clearly he is an investor. We know he's a long-term investor. And as you say, quite rightly, he's now moved into an area which previously he said he wasn't interested in for a number of different various reasons. So then do you think this is only an insurance play?
Well, I think it's both, to be honest. I mean, if you look at the gold price over 20 years, it's actually outperformed Berkshire Hathaway over a 20-year period as well. So, I think you can view it both as inflation, as an inflation sort of, I wouldn't say busting product, but enhancer, and also as an investment product. But I think that's probably one of the main sort of game changers of the market. Is I think previously it was probably viewed as an investment, and now institutions are probably thinking, well, actually, it's not bad insurance. So everyone's got different reasons to be in the market, but I think that's certainly one of them.
One final chart I want to dwell on, if I can, is the one that we've actually just shown, which has been the chart which shows that if you overlay a 1970s gold pattern of trading, if you like, over where we are at the moment on the orange line, what's this telling us? Because clearly there is an outperformance from, if you look back in earlier years on gold as to where we are at the moment.
Yeah, well, I mean, I think you need to bring silver into this discussion as well, to be honest, because if you look at the current gold price, it's not a million miles away from $2,000 an ounce, US dollars an ounce, and for a lot of people, they're sort of thinking, well, actually, that's pretty close to the all-time high, or it is actually at all-time highs if it gets over that. But what this chart is showing is if history was to repeat itself, now that is obviously a big if, but if it does, then the gold price could go a lot higher. Now, the reason I mentioned silver is, silver is still a long way below its previous highs. So if silver was to sort of catch up with gold in terms of the gold ratio, which again is very high, and that ratio is the ratio of an ounce of silver to an ounce of gold, or the price of an ounce of silver to the price of an ounce of gold, it could mean that the silver price could move up significantly. Obviously we don't know, but I think from an investor's perspective, there's a lot more interest in the sector, and I think there's a lot more interest from the institutions as well, which is obviously making it more of a mainstream product than it previously has been.
Let's just round up with one final question. I'm going to bring a chart of the current price of gold in. We showed that chart where there was that outperformance in previous years over where we are at the moment. Have you got any sort of calculations that you can give us that would indicate the potential for gold at these levels at 1953, which is where we are at the moment? In fact, we're not too far away from the support line that we had with that record high that stood for so long between 2011 and when it was broken back in July this year of 1921. We're just a matter of $10 or $15 or so away from that on the upside. What are your thoughts in terms of the potential upside from here, bearing in mind that outperformance we saw in previous years of gold as to where we are at the moment?
Well, it's very difficult to say because there's so many moving parts here, because, especially if you overlay the pandemic, if we get a second spike, then that's going to make, I think the gold price move even higher. But also the extent to which institutions move into the market. And I think one of the reasons institutions haven't moved in is because of probably ESG issues, environmental, social, and governance. And the gold sector, certainly the mining sector, has upped its game significantly. And so that means that there's probably fewer barriers for an institution wanting to put money in. So if we get the sort of the interest from the institutions and the second spike in the pandemic, then it'd be no surprise to me if the gold price went well north of the $2,000 an ounce that we're currently sort of close to. So I view this, I wouldn't say we're at the floor of where it's going to go, but I think there's a lot of potential for the price to move significantly higher than we are today. I'm a bit sort of reluctant to give you a hard number. I know there's people out there who said $10,000 an ounce, $20,000 an ounce. I'd rather not do that, but I mean, to be honest, even if we get a 10-20% uplift on where we are today in the next 12 to 18 months, then that's a pretty good investment.
Okay, Simon, look, we'll have to leave it there, but thanks indeed for joining us. Simon Popple from Brookville Capital. He's the author of the Brookville Capital Intelligence Report. For more videos from us here at IGTV, join us on Twitter at IGTV and subscribe to our YouTube channel.